everybody, and thank you, IGPC, for giving this forum to talk about this paper. So we have been actually working on these issues about safe haven, fires and hedge. This paper is also with one of my co-authors, Professor Arif, who is from SMDVDU, JNK. Because whenever the issue of hedge, safe havens, and uh, diversifiers has been there. Whenever there has been the issue of portfolio management, and it is likely to stay. Why? Because if you look at the extreme movement in the asset markets, we see that the frequency has gone on a rise. Now, this is the recent history, okay, and we have not put out some of the other instances. So, from 14 years, it is just around 2 years now. So the more there is an extreme movement in asset markets, the relevance of safe haven, diversifiers, etc., becomes far more important. Now, when we talk about what we understand by hedge, obviously we know these are assets which are negatively correlated. When we talk about diversifier, they are not correlated. And when we talk about safe haven, they are uncorrelated kind of assets, and more so, they're negatively correlated during extreme event. That's why we call it to be safe havens. So, given this, so what we are looking at, the motivation for this work has been based on a couple of our papers where we try to look into the role of precious metal equities as well as precious metals in the portfolio diversification. Well, the research is biased to the inclusion of precious metal, but there exists a strand of literature which highlights the role of precious metal equities. Well, there's an obvious reason because the valuation of the precious metal equities depend upon the kind of underlying reserves as well as the macro factor and the company management. Besides, it's also a cheaper alternative compared to physical gold. So that can be a very good kind of uh, uh, kind of indicators for this. So now, when we talk about this, as we are saying, we're talking, we're trying to look at the extreme movement because we're trying to look at the safe haven properties. So what we have done is that we have decomposed the asset returns into different horizons using the maximum overlap discrete wavelet transformation. And then we try to look at the quantile correlation because that will give us the correlation at the extreme ends where we can define this issue of safe haven a lot more clearly. But before we go into that, we would like to kind of share why quantile correlation becomes relevant. Now, here I would like to draw your attention on this particular kind of this part. I don't think it's kind of just working out. So if you just look at the graph, the graph in red that shows the rolling quantile correlation between the equity and the bonds, and they tend to be usually negative. That is what the usual perception is. But if we go to the portion of 2020, that actually became positive. That means no asset is safe. Okay, so the correlation doesn't only remain the same across horizon. They change, and that is where the importance lies in trying to look at not only quantile correlation, but what we look at is we look at the wavelet quantile correlation, because that's what gives us the perspective of bringing into the forefront the different investment horizon those might exist in the investment. Because we see some of the people who are investing are traders, some are investors, so there are people with different horizons. Now we have to accommodate that. That is why we have bought this the wavelet thing, and along with that we have looked into the wavelet quantile correlation. So these are the asset classes that we are looking at, and we have our period of study. And these are the kind of different horizons that the data has, that each kind of series has been broken into. And before we go there, we try to do a kind of so-called quantile correlation, we do a multidimensional scaling to understand how these assets are really related. So if we just use a kind of thought that if we put all of these assets together and say that there are only three asset classes, we see that the metals, they turn out to be a separate asset class. The precious metal equities, they turn out to be a separate asset class, and equity is a distant. So we have three asset classes out there. And if you force it into two asset classes, obviously equity still turns out to be a different asset class, whereas the silver or the precious metal stocks and the precious metals has some things in common, which is pretty much intuitive, because the equity market tends to have an underlying of the metal kind of characteristics of the stock. So that is where it gives us. So this gives us some sort of a thought about the similarity or the dissimilarities of the asset classes and how it can be used to kind of portfolio, to diversify the portfolio or as a safe haven. Now, once we have done that, then this is what we do in terms of wavelet quantile correlation. So this is basically a chart which shows how the correlations behave across quantiles, and over the horizon. So this is the chart between gold mining and equity. We see that in the very, on the left hand side is the data which corresponds to the so-called adverse shock, okay, the extreme negatives. And there we see that the gold mining equities tend to have a role of diversifying out there, okay, because the correlation is very, very low with kind of equity. So that possibly kind of gives us certain kind of ideas. Now we can look at this across the way, but that will take more of a time. So I'll just economize on that. There's one more thing. When we talk about gold and equity, this is very important. We see in the extreme events, the correlations become negative. So that's very important. So that brings back the notion that gold is a safe haven asset, actually, beyond being a diversifier or a hedge when things are good, which is on the right hand side of the quartile. So because I was told to keep the presentation brief, I'll just come down to this results, which shows that precious metals are more correlated with the precious metal stocks across horizon, but gold shows more of a safe haven property as well as as a kind of hedge, and silver shows diversifier property at all times and horizons and quartiles. Thank you so much.
Thank you very much, Professor. Just a quick question. You
Yeah,
have
yeah.
compared it with equities. You have taken the broader equity sense,
Yes,
Sensex and all that stuff.
We have taken the global markets because we are kind of.
Okay, you have taken the global market.
Right.
I'm talking. Can the same study be done? For instance, an Indian buying gold.
Yeah.
Okay, and in Indian buying, I'm using this term, but buying Titan.
Okay.
Okay.
Yeah. So that's
Indian buying gold versus Indian buying SME stocks or mid-market stocks.
yeah,
Okay,
yeah.
mid-market index. We have these index. Is this possible to do it with those
Absolutely,
indices?
absolutely.
I think that will be very interesting because then you can actually position it with the ETF, AMCs and all that stuff and says, look, this is the return, but had you put it in gold, it would have been better. Because nobody compares gold with a specific index. They always compare gold with Sensex, broader things.
Right.
Now we have varying things. I think we should compare gold with, say, you're better putting it in SME stocks than gold. You're better putting it in gold than mid-market stocks. So maybe you could
that's a
tell
very
your
good
team
suggestion.
to do
That's a
that.
very
Thank
good
you.
suggestion.
Thank you.
We'll definitely take a look into this. Thank you.
Sorry.
Oh, I think I lost you a bit. Can you go to the last but one slide, please? Yeah, this one. See, I think I lost you a bit here. The extremes you were saying, this is during the COVID times, etc.
No. This is not, because our time period
Okay.
is from 2000 till 2023. So we have a lot of extremes out there.
Okay.
So we have, suppose, X variables, which is the equity performance, those during the extreme periods, and corresponding to that, what has been the performance of gold equities during those periods. So conditional on those on those values of the kind of equity performance when it was not so good. So it is not specific to the COVID period or not. It takes into account all those extreme periods when things were not so good.
I'm just curious to know, were you able to identify certain other correlative factors? For example, I am always curious to understand whether there is price elasticity of demand, something like that. Does gold exhibit elasticity?
Yeah, so I think that would be a different study,
And
madam.
yeah,
Which is not the purview of this study, but that can be done. I mean, definitely it can be done. But for that, you need the actual demand data and the price data. So demand, at what price, how much has been demanded. So that is where the thing would be. So then obviously one can do that.
thank you very much.
Thank you.
Very interesting study. Thank you very much.
Thank you.
Thank you, Professor.